Good day, investors. Welcome to Vested with Jared Bowers. Hey, I could use your help with something. We will soon be approaching the 6-month mark of this podcast. And at some point after that, I'll do our first listener questions episode. I have some questions from listeners, unsolicited, but now I'm soliciting. Would you please send me your questions? And keep in mind, your question is more likely to get featured and answered now, early on, as opposed to later, when we presumably have more listeners. Feel free to submit more than one. If they're both good, they both might get into the episode. I'll keep them anonymous, but you will know that it was your question. They can be about anything. About the podcast, about the topics we've covered, about what you would like me to cover, about investing, money management, fitness, about me, the one topic I'm truly an expert on. And this isn't because I believe that I'm qualified to answer all your questions, but because I'll try. And I'll do it a mix of well and poorly, which I think will be fun. But now I have a question for you. Do you know someone who always tries to keep their options open? Hesitant to commit until they have to. Won't make final plans until the last minute. Not necessarily because they're a procrastinator, but because they don't want to be locked in. Maybe you are that person in one way, shape, or form. To many of us, commitment feels risky. What if a better option comes up? What if I commit to something now and I decide I don't like it later? You know where I see this play out most often on the low stakes side? At the restaurant. In a mixed group, there's often that person in the group who can't decide, who can't settle on what they'd like to order. They're asking what other people are getting. They're asking the waiter what they'd recommend, or asking them to tell them about different options. When it's time for the group to place the order, they say, "I'm not ready yet. You all order first." They take the longest time to commit, and the only reason they do is because they're forced to. And in my experience, they often end up being the least satisfied with what they get. So what's the problem here? Is the problem their indecision? Maybe, but they do eventually get to the decision. Is it that there aren't enough good options? Almost certainly not. It's probably in the other direction. Too many good options. I think the biggest problem that they're facing is fear of regret, which ironically increases the likelihood that they feel regret. Ordering something off the menu locks you in. It removes all other options. And that must be the problem, right? If they didn't have to be locked in, they'd be better off, right? If they could easily swap what they ordered for something different, if they don't like it, the problem would be solved, right? Or it could just simply be solved by every restaurant being a buffet, right? You might be picking up on the sarcasm. I don't think that's right for any of those questions. Hold these thoughts for now. Let's switch gears a little bit. In the last episode, we talked about rebalancing. The key takeaway there was that portfolios drift, accounts grow, and so therefore we need to intentionally redirect resources from time to time. We can trim, size up, or we can fully sell or buy something different, add a new investment. There are costs to rebalancing, and we talked about those. Transaction costs, relational costs, identity costs. And we made a clear distinction between unintentional imbalance that causes issues and intentional imbalance that results in better returns. That the point of rebalancing our portfolios is not perfect balance, but intentional imbalance for a purpose and for a season. But we left out a big part of what enables us to rebalance in the first place. A prerequisite of sorts. By the way, whenever I record that word, prerequisite, it usually takes a number of tries. I flub it more often than not, but this time, I nailed it. Pretty proud of myself for that. And the prerequisite I'm talking about is the ability to move and adjust our resources and account balances in the first place. A key part of rebalancing is having the ability to rebalance. And that brings us to our topic for today, liquidity. How easily am I able to buy, sell, trim, or size things up in my portfolio? Liquidity answers these questions. Can I actually move the resource? What will it cost me if I do? And what am I looking to achieve by doing that? Liquidity is how quickly and cheaply you can redirect a resource. And liquidity is integral to rebalancing. It's the optionality that we actually have to tap into and adjust the account balances that we've accumulated. Take advantage of opportunities and move things around. The lower the cost of rebalancing and the easier it is, the less time and effort it takes, the more liquid the investment is. If you can very quickly and cheaply reallocate your resources or account balances, those accounts are highly liquid. Slow and expensive to move or redirect resources or account balances, highly illiquid. Picture this. When you're cooking, which of these is easier to measure by pouring or by putting into a measuring cup? Milk or peanut butter? Clearly the milk. Which is highly liquid? And the peanut butter is still considered a liquid by TSA standards, which is the gold standard for everything in life, because it can't be argued with. But we know that peanut butter is highly illiquid. It is so illiquid, at room temperature at least, that anyone who's tried to scoop it into a liquid measuring cup has regretted it. By the way, quick tip, measure peanut butter by weight. It'll change your life. At least it'll improve your cooking. When it comes to liquidity and money, and again, we'll set the stage in defining liquidity around financial investing, how quickly and at what cost you're able to move your money from one investment to the other determines how liquid it is, or how liquid you are in your portfolio. Examples of highly liquid investments in the public markets are most stocks and investment-grade bonds. Those include ETFs, exchange-traded funds. Most publicly traded assets are highly liquid. You can trade them every day, multiple times a day on the public exchanges for a low transaction fee. There are a lot of people buying and selling. They have excellent liquidity. And that is provided through an active market of buyers and sellers that is easily accessible. Mutual funds, which are a collection of stocks or bonds or both, can't be traded quite like a stock minute by minute because they're only priced once a day, but they are still liquid investment products, just slightly less so than what trades minute by minute. Money market funds, which are a collection of short-term bonds that you can buy into with your cash, are usually structured as ETFs or mutual funds. Those are highly liquid. CDs, certificates of deposit, are an interest-bearing savings bond product that most banks offer and are considered liquid, but a bit lower on the liquidity hierarchy. They have a future maturity date, and they have a cost that you have to pay if you want to sell them early, before their maturity date. We should keep in mind that something can have a price and be very actively traded, but not have the same level of liquidity as a stock or bond, because it's more difficult to physically buy or sell. Examples of assets that are constantly priced but are slower, less liquid assets would be physical commodities. Let's say that you own gold or silver, coins or bars, or you're a farmer and you have a grain bin full of corn or soybeans, or you're a rancher and you have a herd of cattle in the pasture. There is a market price for those things. Those assets are bought and sold all day long, every day, actually 24 hours a day, around the world. You can know their value exactly to the dollar by the minute. But since these are physical goods, you actually have to move the thing, deliver it to a buyer, or take possession of it from a seller. It's a bit slower and more challenging. So very active market, very liquid in price, less so when it comes to owning, buying, selling those things in the real world. By the way, the reason that ag examples show up in the podcast pretty frequently is because I grew up in a farming family. My wife grew up in a ranching family. I will admit, ranchers do work harder than farmers in most cases, but farmers tend to make more money. Maybe not right now, considering beef prices. So it depends on the year and the decade. Back to the liquidity scale. You may have heard of hedge funds. We may talk about those in more detail in the future, But hedge funds are a collection of assets, often some portion of debt and equity, that have a less liquid structure to them. They're an investment fund that you buy into. Most of them mostly hold public assets, but you will not have daily liquidity. You may have monthly, quarterly, maybe annual liquidity in some of these funds, and as a result, they are on the less liquid side of the scale. Then you get into the realm of very illiquid investments, things like private businesses. If you own your own business, chances are it's not publicly traded. If you want to sell your business, it's not going to be easy. It's going to take time. There's going to be a high transaction cost. And there's not going to be as many buyers. The price is not predetermined. It needs to be figured out through some combination of you stating how much you think it's worth, potential buyers telling you how much they think it's worth, often triangulated with a lending institution who also has an opinion on how much it's worth. Private equity is another example. That's a productized collection of private businesses bundled together in an investment product. That's an example of an illiquid asset because it is a bundle of illiquid assets. You cannot easily sell it. There isn't an active market for those assets. Real estate is probably the one that most of us are most familiar with. That's also less liquid, oftentimes illiquid, depending on what real estate you have. It's not easy to move. You can't log in and just sell it today. You might be able to sell it tomorrow if it's a great property with a lot of potential buyers, but it'll probably take a bit to get the money. It takes time to reassign ownership, to get everything in order. So these are all examples from highly liquid to highly illiquid investments. Liquidity is prized and valued in the world of financial investing because of its importance. Liquid assets will sell for a premium compared to similar but illiquid assets. That means that the market has determined that liquidity, how easy something is to buy or sell, has value. In other words, what this means is that if you have two identical assets, one being highly liquid and the other being highly illiquid, the more liquid asset will sell for a higher price than the illiquid one. Guaranteed. Liquidity has value. But liquidity doesn't just apply to financial investing. We will talk more about liquidity in financial investing in the next episode. But the remainder of this episode is going to be focused in a different direction. I want us to be able to see how this concept of liquidity applies when it comes to life investing as well. Because some investments that we make in life will lock us in. Some keep our options open. And a healthy allocation includes both. And this may be the most important part. Overvaluing liquidity causes problems. Being fully liquid might seem like a good thing, and it does have its benefits. All else held equal, liquidity is a net benefit when it comes to your money. Mostly. We'll talk about the double-edged sword of liquidity when it comes to our money next time. But when it comes to our accounts of life, a healthy allocation in the investments that we have are investments with a mix of liquidities. When we look at life investing, we can identify examples of liquidity and the trade-offs associated with it. Consider where we live. Renting an apartment in a big city is much more liquid than buying a home in a small town. Taking classes online is much more liquid than signing up for in-person classes on campus. When it comes to relationships, dating is much more liquid than marriage. Doing church online is much more liquid than joining an in-person community. Plenty of other examples we can talk through, and we will talk about some of them, but I want to talk more about liquidity conceptually. Liquidity is almost synonymous with optionality. And optionality matters. We like to be able to keep our options open. Keeping our options open can reduce the downside. It gives us flexibility. It allows for easy reallocation and change and adjustment. This is great in many ways in the places that we invest. Locking things in is removing optionality, and that can be risky. Liquidity equals flexibility. But there's this thing called the risk to reward ratio. That is a very important concept in investing. And if we want to hold only the lowest risk assets, we are also making a conscious decision to invest only in lower return opportunities. Higher risk allocations give us access to higher reward opportunities. That is the risk to reward ratio. Remember the decision matrix we talked about a few episodes back? The highest upside investments are in the top right quadrant. High risk, high reward. The magic quadrant is the bottom right quadrant. Low risk, high reward. And those investments do exist, but the highest upside lives with the highest risk. Keeping our options open, keeping a highly liquid portfolio can limit our upside because it puts a cap on accepting a risk that might not be as risky as it seems. As I mentioned earlier, a healthy life portfolio needs both liquidity and illiquidity. You need some flexibility. You need some ability to move when the facts change, when opportunities arise, or when you realize that you made a bad investment. But you also need roots. You need ownership. You need commitments that are not easy to unwind. Because the biggest returns in life usually do not come from the things that you can sell by tomorrow. Many of us overvalue flexibility when that may not be the thing that should be highly valued. Yes, it allows for easy reallocation, but easy reallocation is not always a good thing, and it can be a really bad thing. On the flip side, narrowing our option set, investing in something that is less liquid, locking in, so to speak, can increase risk and remove flexibility and optionality. But that is where the biggest returns often live. That is almost always where the bigger returns live. Where we lock things in, where we invest in illiquid investments, needs to be chosen carefully and allocated very thoughtfully, because it is going to be an exercise in taking options off the table. And that can be a good or a bad thing. Let's talk about how this applies in life. We get it that liquidity equals flexibility, optionality. How quickly and at what cost can you reallocate or move around or redeploy your resources? A very liquid life is one that has a lot of optionality and doesn't have very many firm commitments. Consider someone who has a very flexible work-from-home job. Let's say that they're renting their home, leasing their car, and casually dating. Most of their social interaction happens online. And they're pursuing an advanced degree through an online university. What I just described is a very liquid life. Probably the most liquid life someone can live as a contributing adult. And that can be great for someone who is on the younger side, in their 20s, for someone who is still figuring life out. But consider that same person who has very few real commitments, a highly flexible work-from-home job, is renting their home, leasing their car, casually dating, mostly interacting with people online, but now consider that they are 50 years old. That might be okay, but if that's all you knew about that person, you could probably make a pretty accurate judgment that this person is underinvested and not getting much in terms of returns in life. There are appropriate times in life where we want to be more liquid, and there are appropriate times in life where we should intentionally choose the less liquid option. But beyond liquidity being seen nearly universally as a good thing, even more, illiquidity is nearly universally seen and described as a bad thing. Man, really locked down, huh? Stuck in that same job? Can't get out of that town? The old ball and chain still got you, huh? The way that being illiquid, locked in, is talked about suggests that it's a real bummer. And instead, wouldn't it be great if we could have everything fully liquid? Maybe securitized, like we have in public markets. We could buy it and sell it anytime we wanted to. But when it comes to life, just like in financial markets, liquidity is also a double-edged sword. And one side is much sharper, and it may not be the one that you think it is. I want to move into the next phase of this discussion with a thought experiment, leaning into an unrealistic extreme to learn something important. Let's imagine stock market-like liquidity, but applied to other important areas of our lives, in the assets that we have in those areas. Let's see what that would look like, and if that would be a good or a bad thing. Consider if we had the opportunity to buy and sell the most important account balances in our lives at the push of a button, just like they were a stock trading on the market. And I'm thinking about assets like our health, our relationships, our careers, our hobbies. the things that we care about, that we derive value from. In many of those areas, we are some combination of highly to fully illiquid. We are locked in. Yes, we can adjust and change those things over time through deposits and withdrawals, but we are mostly locked in. Imagine any one of those big areas in life being securitized, chunked into pieces, priced on the market. Other people determining what price it should sell for. And you have a buy and a sell button for them. Let's introduce constant pricing and full liquidity into those areas. Congratulations! We have a stock market for everything that we value. Great, right? Now you have the opportunity to buy or sell whatever you want to, whenever you want to. It's an interesting thing to consider. Instant pricing and full liquidity on these very important areas of our lives. Your job or your career, your friendships, your romantic relationship, your physical health. They all had value before, and now that value is fully known and accessible. Publicly traded, fully liquid, continually priced. Let's look at what that could mean with our physical health. The different holdings in that portfolio of health would be your strength, your endurance, your metabolism, your longevity. All those things are assets. And if we're healthy and investing well in those, they are very, very valuable assets. And to the market, they're even more valuable the less that society collectively has of those things. Scarcity will drive the price higher. The worse off everyone else is on the health front, the better off you are, because your health assets are priced higher. Interesting dynamic. But the question is, what would we do? How would we respond? How would buy low, sell high apply in an asset such as our physical health? I think that most people would respond that you'd be crazy to ever sell any of your health assets for any price. You'd be nuts to sell your strength or your longevity. You'd be crazy to sell a portion of your metabolism, even if you were offered a very high price for it. Hold that thought for now, because first, let's take a look at another valuable asset. Imagine always having a buy or sell button for your marriage capital, your relationship capital with the person that you love. Imagine a world where relationship capital is liquid and constantly priced. The deposits that we make in trust, respect, admiration, love built over long periods of time, the account balances that are hard fought and have incredible value. Relationship capital, we know, is priceless figuratively. But what if it had a price literally? Again, we recognize that most people would be crazy to sell relationship capital for any price, especially for something so cheap as money. But if you had the opportunity, the option, to buy or sell at the push of a button, you'd only be buying, especially when it's low, and holding on to it, right? You'd never even think about selling it when the price is low, right? Well, based on the behavior that people exhibit in another very important area of life called money, that is not the case. Most people do exactly the wrong thing. And if we applied this active market to other valuable assets in our lives, most of us would do the wrong thing. If money was offered, if the price was high enough, or especially if panic sets in, if these assets were liquid and constantly priced, they were securitized, and we had a sell button, most of us would be selling at the wrong times and buying at the wrong times, mostly based on fear and greed that volatility would generate and the opportunity that liquidity would give us to do it. A fight in the relationship? Push the sell button. That's selling when the price goes down. A panic in the market and relationship capital is selling off in general? Better get out. What if the price falls more? When the price is nice and high and things are going well, good time to sell, right? Get out, lock in some of those gains you got. That is what people do when it comes to money in the market. Not just because it's money, but because they have the opportunity to do so and the emotional drivers that tempt us to do it. When applied to our assets of health capital and relationship capital, we can see it's crazy, it's dumb, when we look at it conceptually like this. But the wrong moves would happen. because that's exactly what people do in financial markets. And it's not just because it's with money. It's because it's something valuable that they care a lot about, but then they have the option of full liquidity. Thankfully, these important accounts of life happen to not be liquid and happen to not have daily pricing attached to them. Thankfully, there's not a public exchange for relationship capital or for health capital. And that is a very good thing. Being locked in when it comes to the most valuable assets in our life is mostly a very good thing. Just considering those two examples, our health and our relationship capital, we can identify that yes, there are going to be ups and downs, volatility. It's not a perfect path upward in any meaningful pursuit in those two categories. There are periods of progress and regress. But if we're investing well, the expected return is positive. And we're confident that those account balances are going to be higher in the future than they are now. And therefore, when it comes to areas like our health and our relationships, we can identify pretty clearly that the only right thing to do is to make investments, is to make deposits, is to buy into those areas with positive expected returns, even when the price is high. And we should never, ever sell unless we absolutely have to, unless we need to make a purposeful withdrawal, not to try to time the market, not to try to take advantage of price or run away from volatility. Those accounts are so important in life that we should do everything we can to grow them and have them working. Leave them invested. Not trade it for something so cheap as money or run away because something is volatile. And not think that we can time the market with those things. And I believe that we are so fortunate that many of the valuable things in our lives are not securitized, are not liquid, are not constantly priced, and therefore not available to sell in fractional quantities. It is a benefit to us that the areas of our life that have important capital balances are not constantly priced and constantly liquid, because most of us would be worse off in that case. There is an important nuance that in a world where that liquidity and securitization existed, some people would benefit. And I think this is important to point out and consider and admit. There would be people that would be better off in that fully liquid world, in a world where priceless assets are constantly priced and constantly liquid. Now, who would those people be that would be better off in that world? The people who would be better off are the disciplined investors, portfolio managers, who are sticking to a disciplined and proven investment strategy and are spending most of their time buying and very little of their time selling. If they ever are selling, it is a well-reasoned, thoughtful rebalancing exercise where they are moving capital around from overpriced to underpriced, but staying invested. When things are on sale, those disciplined investors would be doing everything they can to buy more of it. Not because they tried to time things and sell out at the top, but because they're looking to build a portfolio that weathers through the ups and downs. And they are looking to be an owner and they want to own more. But that fully liquid world doesn't exist. And that is a good thing, because the less liquid option is often where the biggest and best returns exist, where the best long-term results are. Part of that is because it removes the option for us to be stupid and do the wrong things. As you move through life and you establish yourself in life and you become vested in life, you want to have a portion of your portfolio that is fixed, illiquid. Examples of high conviction, low optionality, illiquid investments in life are getting married, starting a business, putting roots down in the city that you live in, starting a family and having kids. These all, of course, require very careful selection. They require high conviction. They require a willingness to accept lost options, closed doors, and the possible downsides that come with them. But you cannot capture significant upside volatility, which is a good thing, without paying the costs. And if it is a worthwhile investment, the illiquidity and the downside volatility may not feel good, but those are worthwhile prices to pay. So much of what we hear out in the world is that we should avoid committing. Avoid being locked down. Keep our options open. Stay liquid. That is bad advice. And it becomes worse advice as you progress through life. Because staying fully liquid in life is exactly how you avoid becoming vested in anything. This is true in my life, and it's true in the lives of the other successful people that I know. For every major area of investment locked in, other options had to be taken off the table. And in every one of those areas, it comes with uncertainty, increased volatility, and what could be accurately described as risk. And those areas and assets invested in well will be worth it. They have absolutely been worth it for me and those people I know who practice the same approach. If we want the possibility of the best returns, we need to have some illiquid investments. Lock in some things. Get married, have kids, buy the house, become a member, start the business. Truly be invested in something. Invest and invest with purpose. Don't just look for ways to keep your options open. We value what we invest in. It's widely believed that the stronger relationship is the other way around, that we invest in what we value. It's actually more true in reverse. We end up valuing what we invest in. The things that we value do pull our resources, but the more powerful direction of that relationship is that what we invest in, we end up valuing more. Liquidity can be great, don't get me wrong. But a life of all liquid investments is a life that is waiting for real progress. My family has been planting a lot of trees recently. If we want to keep our options open with the trees that we have, so that we had the ability to move them at any moment, they would be spread around the property in pots. Or we would be uprooting them and stunting their growth. Every investment decision should and often does require a liquidity decision. How locked in are you? How locked in are you willing to be? Volunteering to officiate a game on a Saturday locks you in for a few hours. Volunteering to coach a team for a season can lock you in for a few months. Volunteering for a nonprofit board can lock you in for years. Starting your own nonprofit to do the work that you are passionate about can lock you in for decades. We should know what we're committing to, and we should do it with intention. We should account for that liquidity that is involved. The decision around liquidity is an exercise in deciding what doors to open, what doors to close, what doors to walk through, what doors to leave open behind us. And we need to be intentional about all of it. But make sure that you do firmly walk through some doors and close them behind you. Commit to the decisions that you make. Invest with enough concentration and enough intention to make a meaningful difference. And oftentimes, we will invest better and we will invest more intentionally when we commit. Because that's the direction that we have chosen. We care more about what we invest in. And can you see why we talked about risk, asymmetry, volatility, and rebalancing just ahead of this discussion? I'm glad we did. And just in case the pendulum of this discussion is swinging too far one way, I want to make clear that both liquidity and illiquidity should have a place in your portfolios of life. When we look at our portfolios through the lens of liquidity, we should have an appropriate mix. How much liquidity do we have? Do we have any depth? Which usually requires some level of illiquidity. Are we always keeping our options open, or are we going deep with any of those options? Remember that question that we opened this episode with. The person that's always trying to keep their options open, hesitant to commit to anything, trying to hold onto full optionality, keeping things fully liquid. They are precluding themselves from the biggest returns in life. On the other side, if our life is so locked in everywhere that we feel like we don't have any other options or don't have the bandwidth for anything else in life, that is also bad. We should have a balance of liquidity and illiquidity in our lives. And our lives should look different as we get older. Again, thinking about that person in their college years or early 20s, probably going to be a very liquid life. But if they remain that way, they're leaving returns on the table. A lack of returns is often symptomatic of a lack of commitment and can be driven by a juvenile desire to keep our options open. I've seen this manifest in a couple big ways through recent examples, and I'd like to talk through them. The first is not committing in relationships, and the second is not putting roots down in a community. Massive gains are left on the table from both of these. Let's talk about the marriage one first. There are too many commitment-averse guys out there who are just kicking the commitment can down the road. I usually don't love doling out unsolicited relationship advice, but, my gal, if he should have asked you to marry him years ago, he is probably a man-child who is afraid of commitment. And you can choose that if you want. But you are probably getting an accurate glimpse into the type of investor that he is. So do not be surprised with the future returns. And do not be surprised when you realize that you are part of his liquid portfolio, that he makes sure is easier to sell in the future, if needed, instead of being part of his illiquid one that is locked in, that is committed to, that is being invested in. I guess a question I would ask on that is this. Is he more committed to his truck than he is to you? Which title is his name on? That may not have been the example that you saw coming, but it illustrates liquidity and illiquidity in action in life. One results in better returns, and a preference for either tells you something. And now the other example. Keeping your options open and not putting roots down in a community. I see this even more commonly than I do with the relationship example. I recently had a conversation with a couple who was talking about moving across the country on vibes. Not because of a job change or a better opportunity or the chance to move closer to family, but because they just didn't have any roots in the city that they've been living in for a decade. So why not? Just thinking about it for now, definitely wanted to keep their options open. And when that couple in their early 30s told me this, my first question to them was, what about all the connections you've built where you've lived over the past decade? And their immediate, straight-faced response was, oh, we don't really have any. And they said it like it was a good thing. It is only a good thing in the sense that it makes it easier to leave. There is a time and a place for keeping your options open. But there also comes a time and a place in our lives to close some doors and to put down some roots. Part of growing up and getting real and lasting returns is making real and lasting investments. Illiquid ones. And far too many people in their 20s, 30s, even 40s and beyond resist putting down roots in their community, thinking that keeping their options open is the right thing to do. Don't get involved. Don't become a member. Don't buy the house. Don't invest in your community. Don't lock yourself in. But what that results in is a shallow and low return life. Keeping your options open is great until it isn't. Chances are you probably don't see yourself in those two examples that I talked through, and that's good. But using those two examples to look through as a lens at our own lives, what I'm asking you to do is consider where in your life you're holding on to liquidity where you shouldn't be. Where are you keeping your options open where you should probably just commit, and then put your resources toward it to achieve the thing that you want to achieve, to go after the returns that are there? And when it comes to applying this idea, I'd like you to consider if you are treating important people around you as liquid or as locked in. And then adjacent to that, whether you are part of someone's liquid or locked in portfolio. And then my encouragement to you is to invest in the relationships that are long-term assets, where you are treated as a long-term asset and not as a rental. We'll also have liquid investments, and we should. We'll always have more liquid or more transactional relationships with certain people. But there's the other side to that. We should have relationships where the person on the other side would feel like you are investing as an owner. You are investing not as an option, but as the choice. Locked in, illiquid. Oftentimes, we want to be invested in as the chosen asset, but yet we invest with our resources to keep our options open as a renter. And depth, progress, returns, as we have established, exist most strongly on the owned side of the equation, the less liquid side. If you want to be the invested in and the chosen investment, not as a liquid portion of someone else's portfolio that can just be trimmed or sold in the future, then we need to be doing the same thing. We need to be investing in a way that will allow us to become vested. And another encouragement, start considering the value of illiquidity, being locked in a world that overvalues liquidity, keeping our options open. Look for ways that you can enhance your portfolio by adding a bit of illiquidity to it. Get involved, become a member, buy the house, invest in your community, put deep roots down that are hard to uproot. Ask the big question. Start the family. Lock yourself in. The biggest returns are on that side. Except, liquidity is always good when it comes to financial investing, right? There's no way that anyone could make the case that liquidity is a problem or that we shouldn't have it in money portfolios, right? Well, I am not anyone. I am me. And of course I can make the case that liquidity with our financial investments is not as good a thing as it's cracked up to be. And it's really a bad thing in many cases. But that is for next time. Okay. Thank you for investing in yourself and in those around you. I will talk to you next time. Is he more committed to his truck than to you? Oof. I might be asking for trouble with that one.